After trading for over 30 years, after teaching others how to trade for over 20 years, I can tell you that there is a simple mistake that many traders make, and it costs them a lot of money. And that's this week's topic. So before we get into my normal market analysis, let's dive into this one mistake that I don't want you to make. Very simply, when we are trading the market, the quality of the company is trivial. Now I'm talking about trading. I'm not talking about putting a stock in your retirement portfolio for the long term. In that scenario, absolutely, the quality of the company is important. But when you're day trading or swing trading a stock for a move over the next hour or the next few days, the quality of the company doesn't really matter. What we're doing is buying and selling quickly, not because the company is good, but it's because the situation is good. As traders, we are not trading the company, we are trading the situation. And by the situation, I mean the probability that the stock is going to go up in consideration of the relationship between risk and reward. So let's dive into a chart and I'll show you a great example of this. The situation on this stock was that it was behaving abnormally right here. It was doing so from low volatility. In some of my recent videos the last few weeks, you'll know that I've been really pushing this concept of action candles, abnormal activity, breaking from low volatility. And make sure you're subscribed to the Stockscores YouTube channel because I'm doing these free education videos every week and you'll learn a lot from them. All right, so this stock gave us our signal right there, breaking through resistance from optimism, low volatility, action candle, that's the pink and yellow dot. And it did very well. It went up almost 100% from here, actually about 100%, $6 up to $11. You would think with a price move like that, that this company was a good company, that there must be something good there. But that's not the case. What it really was all about is a catalyst that got people excited. People jumped in. Traders had the fear of missing out, pushed the stock up way too much, far beyond what the fundamentals of the company are worth, but you could still make a lot of money on that. A classic pump and dump. The stock gets pumped higher. The bag holders get left at high prices holding the bag, and then the stock came crashing back down to earth. Look what happened. Over the next 2 days, it went all the way back to well below where it started. And so the key thing is if you believed in the story and you're buying here because you like the story, you got crushed. Because eventually the market reset, went down to where it, well, far below where it was because the story didn't quite live up to the hype. So if you want to be a good trader, don't fall in love, don't listen to the story, just trade the situation. All right, let's get into this week's analysis of the overall markets. And for that, I'm going to jump to my website, stockscores.com, and we'll look at the chart of the indexes.
Let's start with the chart of the S&P 500. This is the daily time frame, and you recall last week I was concerned about this upward trend line here that had been broken. Now the point was it was broken after hitting a new high, and that's not a reversal signal. Typically reversal signals come after the build of a falling top and then a breakdown. So what we've done the last week is moved up toward those highs again. So we're almost at the point where we have negated the breakdown, because if we can get back to these highs, then there's no falling top. If, however, on Monday we roll over and move lower, then we will have broken down from that falling top, and that will be a negative signal. Now the best way to watch for that is go to Stockscores, watch the SPY chart, and look at it on the 60-minute interval, because there you can see more clearly the general upward trend here, the new high, and right now we have a falling top. Now we haven't broken down from a falling top. We would have to move down through this line. So it's an important point in the market. If instead we are able to get back to these highs, then we're probably just going to go into a pattern of sideways trading as we go into the fall. And that's typical. September tends to be a weak month for the market. All right, let's take a look at the NASDAQ 100, because it has managed to get back to those highs. You see the difference there? We have resurged back to that high point. So again, probably we're just going to see the market go into this range. We could just see it continue higher, but it's no longer too worrisome on that chart. Let's take a look at the IWM, which is the small cap market, and certainly much more interest rate sensitive. And you can see here it is underperforming the large caps. It has a falling top. And again, if it starts to roll over and move down through this trend line there, then we'll have to get worried about some more weakness in the small caps. But as I've been saying the last number of weeks, the best opportunities are in the small cap stocks. It's just you have to pick them based on their alpha characteristics, their abnormal volume, their abnormal price action. Most small cap stocks not doing well, but some do great. Here is the Canadian market, and it is at new highs. And so whether we look at the daily, the 3-year, or even the intraday chart, the 1 month, you can see that quite a bit of volatility this past week, but the market is still liking the Canadian market overall. All right, let's move along to gold. And gold is in this nice pattern. This is an ascending triangle. If we draw a line across the bottoms and a line across the tops, you can see an ascending triangle. Now I'm going to show you this kind of concept and patterns at the end of the video when we look at the trade of the week. But the idea here is that volatility is compressing. So you have a lot of volatility here, you pull back, and then with each wave up and down, they get less and less severe, and that is compressing volatility. What that means is that buyers and sellers are coming to some agreement about what gold is worth. Here there was not a lot of agreement because price was moving up day by day by day. Now we're going into this pattern of compressing volatility, and think of it like a coiled spring. Eventually it can break one way or the other, and that's typically what happens out of these patterns. Now because it's an ascending triangle, it's more likely to break to the upside, and so you want to watch for is a break through that ceiling price, resistance level at around 315, 317 on the ETF. All right, moving along to oil. USO is one of the oil charts we can look at. And what we see here is a very trendless chart. It has a lot of volatility. It goes up, it goes down, it goes up, it goes down. Here, lots of down. That means, volatility means, that there is uncertainty. Investors really aren't sure about the oil market in the short term, in the daily time frame. If we go to the 3-year weekly chart, we see that it's just basically been in this sideways trading range for quite some time. When it gets to the top of that range, there's pressures to sell, and we see it move lower. When it gets to the bottom of the range, there are buying programs that come in and sort of hold it from going down too low. So it looks to me like oil is just a price that's being managed by supply and demand from the major oil producing nations. Moving along to currencies, UUP is the US dollar, and it's had obviously a very negative run, but it's been stabilizing the last 3 or 4 months, and it's starting to build rising bottoms. You can see there little rising bottoms, basically overwhelming those fallen tops. But until we can break through this ceiling price right here and start to move into some upward momentum, the US dollar doesn't look particularly healthy. It's not as negative as it was, so we're pretty much neutral on the US dollar. Bitcoin is something that obviously many speculators are interested in, and it's been a little soft the last 6 weeks or so. You can see right here just this general weakness there, but it's not a big deal because we're still in this cycle of rising bottoms, and it's more clear when we look at the 3-year weekly chart that the upward trend is intact. Now, one concern is that the pace that the bottoms are rising is steeper than the pace that the tops are rising. What that means is that investor enthusiasm is lessening over time. We had a lot of enthusiasm here and then pretty good enthusiasm there, but this time it's a little less, and so the buyers are getting less motivated to chase Bitcoin higher. So it's still a hold in the long term. In the short term, obviously a little bit of weakness, kind of a neutral chart in the short term. All right, let's finally take a look at the bond market. TLT is the symbol, and there you can see that bonds have been more or less sideways, much like the US dollar, more or less sideways for the last few months, starting to build rising bottoms, but still has this overwhelming pessimism to overcome. If we go to the 3-year weekly chart, you can see it more clearly there. This is still a high interest rate environment. Yes, the US president would love to see interest rates lowered, but the Fed doesn't seem willing to do so, and that shows up in the chart there. All right, so my ratings then, a lot of neutral. The only thing that's bullish for stocks is Canadian stocks because they've managed to get to those new highs and continue the upward trend. But the large caps are very close to doing so. The NASDAQ kind of tickling through that resistance already. Gold, oil, US dollar, all neutral. Bitcoin, I've lowered my short-term rating to neutral just because it seems to be stuck. But the long-term rating is still bullish, and then bonds neutral on both time frames. All right, let's get into the trade of the week, and I want to emphasize again this concept of compressing volatility because it's great when you're day trading as well. So Here we have, let me just bring that back here. Here we have quite a bit of volatility, prices moving up in waves. And then you can see if I was to draw a line across the bottoms and a line across the tops, that those lines are converging toward one another, which means the volatility is compressing. Now what I'd love to see is on stocks that are abnormal, that then make my action candle breaking from low volatility, they typically move sharply higher. So I'm monitoring the market constantly throughout the day for stocks that are in play, that are abnormal, and I'm watching them for my action candle indicator to fire. Now I don't care about this action candle because it's not breaking from low volatility. Same with this one, it's quite volatile into that. However, this action candle comes from compressing volatility. You can see the bottoms are rising, the tops are falling, and there's a break. And here we have compressing volatility and a break. And the big run out of that going from 220, 230 up to 340 in a little over an hour. So that was a great trade on Friday. It was pretty quiet on Friday, but that stock managed to make a great run higher. You got to be a seller when the upward trend is broken. You can see there the upward trend is broken from a falling top. This going back to some of those concepts from earlier in the video. So there you have a little falling top, break the upward trend line, and then the party's over. Well, I hope you've enjoyed this week's Stockscores Market Minutes. I'll be back again next week for more analysis. Make sure you're subscribed to the channel. And as always, trade well.